Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And it is good to have you with us today. My name is Seth Cressman, joined here with Ben Brayshaw and Dan Mickelin. What are you guys doing today?
I'm doing a radio show. What are you doing today?
What are you doing? What are you doing here?
Seth's participating in a radio show. We're doing the radio show, Dan.
That's right. That's usually the way it goes.
Thanks for showing up, Seth. Thanks for being here.
It's great to have you guys today. It's good to see you guys, and I'm looking forward to this show. We are going to be talking about growth versus value, investing for financial success. This is some of the topic that one of those topics that we're going to be able to pull out some of our heroes in investing today. I think some of those leaders in our industry to kind of define some of the demographics of investing for you and pull it apart and try to find out what is the role it plays in your financial planning. So it's an exciting topic, one that we spend a fair amount of time in when we're talking about market and conditions and, how portfolios are reflecting the values of our clients and their risk and what they're looking to accomplish towards those retirement goals. So those things inside of this show for you today. Is there anything that's on your heart for investing that we have not brought to the table here at Money on Tap? If so, or a question that you have, we love the feedback, and getting a hold of us at 855-226-8551 is the fastest way you can do that. Of course, our info@yourmoneyontap email is a great way as well. Those are just spots where we get an opportunity to communicate and connect with you as our listeners, and that's part of what we love doing here at Money on Tap. Is really we're doing shows, we've got topics, we're all financial planners, and we're bringing things to the table that we're working through every day, and we really think it's important for you to elevate your understanding around. And then there's the stuff that we're just we're not aware of that's packed into your life. So give us a call. And we look forward to bringing that to the table, because guess what? You're like somebody else out there that has a question that needs an answer. And we love an opportunity to do that with you.
Yeah, I would just say, if for our listeners and so forth, subscribe, just get involved, get the reminder to listen to the podcast. There's nothing that you're not going to walk away with. And one thing I find about listening to podcasts, no matter how excited or not excited I am about a topic, like I always learn something. And I think, for some people, financial issues and financial matters, like it's one of those things that's like, I should be doing this. But I'd much rather listen to this, suspense thriller podcast that tells about some, mystery. We all have those things, but really, just take the opportunity to subscribe. Try to get, one or two shows in a week, a month or something, try to create some sort of checkbox for yourself, because there's a lot out there. And I know that, for a lot of people, we're talking about growth and value this week. A lot of people say, well, I'm not a stock trader. I really don't want to be, stock focused. And people get concerned and fearful about that. When we do investments, three-dimensional investing, we handle all the gamuts for people to really find a solution that fits them, that really, both addresses their risk, their concerns, their fears, focuses on either building income or, some sort of, financial wealth for a family or a loved one. Whatever your goals are, it's tailored to you. And I think that's what a lot of people get afraid of. But today, talking about growth and value, there's something you can get out of this, because the stock market, no matter what you're doing, whether it's the Fed fund rates that's driving the market or something else, somehow, some way, your money's going to be connected to this. It just doesn't matter. It's like, we talked about they downgraded the U.S. debt again. Well, that affects the value of your dollar in your wallet that you never put into the market. You have a constant moving ebb and tide, and people try to feel like, well, I'm not involved in that. The truth is you're always involved in it. It's always part of your life, and you got to figure out how best to ride that wave, and how who to hop on that surfboard with you.
Yeah, this show and this topic kind of always hits home. And my grandfather was a do-it-yourself investor, and he just always had these kind of pearls of wisdom. And I try to remember lots of the lessons, that he gave me along the way. And he probably wouldn't have identified himself as a growth or value investor. He probably wouldn't have known the difference definitionally, but he had certain points and certain advice that he would make about how he chose to invest his money over time. And as we kind of go through, some of the advice offered by these, kind of classic value investors, it was all very much the same. It was the same kind of things. And, not to let the cat out of the bag here, we'll get there when we do, but, that's part of this story that always kind of touches my heart, saying, you can find a direction, you can find a style, you can find an investment opportunity that's comfortable for you because of things you believe in, and you don't necessarily have to label it one or the other. It's just, how do you make your decisions? How disciplined do you stay to those things? And do you have the patience to hang in for the long haul? And if you do, I think you'll find success.
All right. Well, we've got that teed up nicely for you. We're going to jump into Money in the News.
And first up, coming to us from CNN, from Brian Mena, U.S. business feels better about the economy but still can't find enough skilled workers. And this is something that I think continues to be a challenge. And I think it was in the last show we talked about the labor market finally showing a little bit of kind of tightening, which is one of the Fed's goals in this. But, based upon this survey of business owners, it is still a significant struggle out there. 42% of the owners said they had job openings that were hard to fill, which are unchanged from June. And 92%, and this is shocking, reported that they found few or no qualified applicants whatsoever. I know that's something that we've experienced time to time where we're looking to make hires here. You run an ad with some kind of specific bullet points and requirements and expectations for someone who applies, and you just get a whole host of things that really come out of literally left field or right field or I don't know what field, but not the one I'm looking for.
Yeah, it's like looking for someone with experience in financial management. I ran a cash register.
Yeah.
It's literally it's so far outside the scope. It's pretty funny. I mean, listen, you never know, right? So people apply and so forth. Some people are checking boxes, but skilled labor is really, really hard to find. I mean, I think there's more people out there to do jobs, but finding people who are well suited has been a problem. And we work with so many people with small businesses that have struggled really finding the right person to fit, their niche or their need. Like it's really, really hard. And honestly, there's a lot of people out there that don't want to work. They'll take the job, they'll take the paycheck, but they don't really want to do the work. And that's a problem.
Yeah.
I love the mindset of some of the people that are, some of it's generational. I got to admit it. It's just, I see it in a younger group of people coming in that they do have a bunch of skill sets and they're far more advanced in areas that I just don't have, because they're involved in Instagram, social media, and doing all these different things. And they've just kind of been raised in a different way through technology. And there's value in that. And they know it. They know that they can come to the table with things that we just don't have. And that's not necessarily in the job description. We're asking for some certain things over here to start to be accomplished. Now, I think what's beautiful about the opportunity here, I feel like there's always a challenge and an opportunity within a challenge, is that somebody that can come with some great attitude, willingness to set aside those expectations of being hired at the highest rate possible at this moment or above the paying standard rate for that job, and put aside some of those things and learn some new skills, and then prove themselves with some kind of mentorship or leadership above them to just come in and really knock it out of the park and then bring the rest of that to the table. So, maybe there's a little bit of an ebb and flow here, but for everybody too. But one of the things that this highlighted was that the student loan repayments restart later this year. There's a little blurb at the bottom. Student loan repayments restart later this year. Americans will eventually have to contend with that. I'm like, oh. And that's something that has not been a very hot topic, is it? Little, just tuck that in underneath there. We'll see how that works itself out. I'm sure
if you don't have
some more forgiveness, but
well, in between like not having a place to live and having a place to live, like somebody has to work. You know what I mean? So,
Yeah.
Hey, listen, I don't have to pay my student loans. I don't need to do this. I don't need to do that. And the government's still sending me money, or I still have cash from last time. Like, people are like, I can buy my Starbucks and I don't need to go to work 40 hours a week or 60 hours a week. I mean, we work more than 40 hours a week here. Like, that's part of life. I mean, my dad always said, if you're working 40 hours a week, you're really not working. That was how I grew up. So, so from that perspective, that's not how the general public sees it. It seems like right now, or at least the workforce coming in to replace the next workforce.
Yeah, work ethic is, I think, something in general that's just changed. It isn't what it used to be, and that's kind of scary, because I don't think the world's going to get any less competitive in the next generation or two to come. So, for those of those people fortunate enough out there to have that work ethic, I think that's just going to be a massive advantage versus the field.
Yeah, even if it's not a skill set, people just want people who are going to work hard and get the stuff as best done.
Just show up.
Yeah, just show up. Yeah. Well, I think. Well, the thing is, sorry, Seth, but the thing is that just the number of people retiring versus the number of people coming in the jobs force it's not a replacement scenario. So we have this whole additional competition that's coming down the line. So these job numbers, in my mind, they mean nothing. We have the worst stuff coming ahead. That's why technology is something in our industry we need to lean on so heavily.
Well, speaking of work ethic, not work ethic, U.S. housing affordability at an all-time low. It's more difficult than ever to afford U.S. housing, by Brett Dumas, Fox Business. Thank you for this article. This is not surprising with what's happened in rates recently in the housing market, and also, guess what? Prices just continue to kind of keep ticking up. So what's happened in the market? Well, as of Friday, the median home mortgage payment hit $2,605 a month, up 19% from a year ago. The big news in this is that the housing payments on average in Hawaii are now above $5,000. Or Californians, it's $4,800. Massachusetts, $4,000. So not too far off of that mark, and that's something that I think is pretty common across the board. Now in Portland, one of the things that we've seen I don't know that it's necessarily a slowdown, but one of the statistics I saw is that more people are actually leaving Portland than we've experienced in a long time. And I think that there's lots of reasons for that. If you live here, it's a conversation we have regularly. And it's good to see that people are sticking around your part of the country and just, loving the Northeast.
Well, I think there's just a bunch of crazies. There's a bunch of crazies in a lot of different places, and it's definitely affecting everything. So where housing is skyrocketing is a place where there's a little bit more sustainability to predictability. So in life,
yeah, one of the things I thought was pretty crazy about kind of reading through this. So right now, there's 37 states that require at least 30% of the median income for a new home, which 30% sounds high. That makes a budget pretty tough to meet. But in California, it's 64%. I mean, imagine that.
How is that even possible? Like, how do they write a mortgage at 64% debt to income? That doesn't make any sense to me.
It doesn't seem feasible at all.
Well, it's not.
It's not Fannie Freddie.
It's not Fannie Freddie.
It's predatory, if it's anything.
It's just more bad government. Just more bad government by California, unfortunately. So, and we're all going to end up paying for it, sadly. Anyways, let's talk about something that sounds fun. So, Mark Zuckerberg not holding breath for cage fight with Elon Musk. Now, okay. Show of voices here instead of hands. Who thinks this is actually going to happen? I don't.
But I am super hopeful. I've got to tell you that.
Oh, yeah.
There should be a whole tournament. All the, mega tech CEOs in a steel cage match. Survivor wins it all.
I would like to see Zuckerberg just get it handed to him. I mean, I just don't think that's going to even happen, but I don't know, Dan. So, hey, this article by Dan Milmo from Global Technology Editor here. Oh yeah, where was this from, Dan?
It's from The Guardian.
Oh yeah, The Guardian. So this is really interesting because this has been going on since June. They've been talking about this. Hey, we're going to fight and so forth. But I was reading yesterday too that Musk was saying that he had to have surgery before he does the fight. I was kind of like, well, that may not be your best scenario. But Zuckerberg has all sorts of MMA training, and he's gotten into martial arts on some level, and it's kind of interesting. But I know nothing about Musk and his ability, but he is twice the weight. So I don't know. What do you guys think?
Well, it reminds me of Karl Malone versus Dennis Rodman. That's what it takes me back to. I don't know if any of you remember that WWE matchup after they're going head-to-head in the playoffs. And I'm trying to remember if they actually got to the finals and it was during that or if it was right before that. I'd have to look at that. But anyways, two completely separate industry jumping into a ring, fake or whatever. No, I'm telling you, that is not a fake scenario. If they are doing WWE, those blows are real. And I tell you what, it could end real quickly if Elon has something that we've kind of in the tank that we're not familiar with, or it could be handed over to Zuckerberg, who's doing this on a regular basis. And I'll tell you, as at one point a 280-pound guy that was doing jujitsu, I was getting schooled by 140 pounds regularly, and part of that was a conditioning, and part of that was there's a real skill there, real skill. If Zuckerberg were to get his hands on him and tie him up, it's over.
Well, I mean, so Musk, he tweeted last year that that a sumo wrestling bout caused him this back problem. So, I mean, he's not without some sort of competition enough to have brought it to the attention. I just wonder if he said it before he knew anything about Zuckerberg. Like if he was just, I challenge you to MMA. Like, oh, darn it.
I love how it's going. Like the proceeds go to veterans, and then what was it? Zuckerberg says, well, we might want to choose a more reliable platform that can actually raise money for charity.
I think, I don't know if does Zuckerberg even have a tweet account? If I was Musk, I would just delete it.
He's definitely got a little bit of that evil genius thing going on. So I'm just very interested in seeing this happen. Although I agree with you, it's a long shot that it ever actually takes place. Maybe they'll send in robots to fight on their behalf or some kind of proxy. But it would just be too much good fun if this actually happens.
Yeah, it would only probably last about 3-4 minutes.
Yeah, no, they're going to need a lineup of some other fights. They're going to need some undercards, and I can just kind of salivate thinking about picking who should be in this whole melee here. But
I definitely want to.
Yeah, I think this whole fight will last about maybe a minute and a half. I mean, it's going to be quick.
Yeah, somebody's going to.
A minute and a half in that octagon is a lot longer than people realize. That is.
The first 30 seconds isn't long. It's the next 30 seconds that's long when you take the first hit and then you're like, oh, man, what's this?
Yeah, a couple of swings each, and then they're going to need a break, but it's going to be great.
Speaking of great, you're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap. And one of the things that Ben did mention is if you're out in the podcast world and you subscribe, well, we'd love to send you some Money on Tap gear. As a thank you for subscribing, just drop us a line, let us know, and we'll send that out the door to you ASAP. We are going to be talking about growth versus value investing for financial success. Can't wait to get this show on the road. We'll be right back. Hey, this is Seth Cressman with Brayshaw Financial Group. Are you looking for a hassle-free way to invest? Look no further than Brayshaw Financial Group. With Brayshaw Financial Group, you can start investing with as little as $100 and enjoy a user-friendly platform with diverse ranges of investment options. Visit Brayshaw Financial Group and start your investment journey today. Brayshaw Financial Group, investing made easy.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And love to throw it out there again for our podcast listeners. The subscribe button is right near your thumb. Boom, you got it. And with that, go ahead and send us a message at info@yourmoneyontap or give us a call at 855-226-8551. We'd love to send you some money on tap gear. And it is pretty fresh, by the way. If you haven't seen it, it's hot. It's super hot. We can't wait to get this to you. And with that, we have got the main part of the show. No, we're going to not bring up any more Elon versus Zuckerberg for this show, but we are going to get into a couple contenders that have been known to go head to head from time to time in the marketplace, and that is value, and growth. Both of these places, where can you invest for financial success? This has a lot packed into it. And I love really, Ben, what you were saying earlier, kind of about people's investment styles. Sometimes people just don't want stocks, won't want to come near stocks, don't want to understand anything that's just not in their DNA. And we understand that. That's completely fine. Regardless of your personal investment style, these are fascinating places for us to spend some time. And at some point in time, if you are an investor, they do play a role. And that may not be necessarily because it's what you have in your portfolio at the moment. It may have more to do what's kind of passing through the investment cycle or the economy and what is happening inside of your own personal investments. And that might be some super safe place, what the CDs or the fixed income world, or it might be your own personal business. Either way, let's go. Cannot wait to uncork this with you today. So first off, Dan, did you want to get into the differences here or what's going on in growth and value investing and uncovering those for us?
Yeah, Seth, thanks for setting that up for me. So I think the key difference between growth and value is all about the valuation of the company and kind of expected returns. Now, there's some ancillary benefits that go along with that relative to safety and kind of price predictability, but there's the real driver to it is the price. A value stock is something that is considered to be undervalued, right? That's where that value word comes in, which is a key player in this. And the things you look at to help determine that are some very easily found metrics like PE values and the book value of a given stock. And these are things that you compare to. A PE value can be compared rather to the PE of the S&P as a whole to give you a driver as to whether this particular company is undervalued. And when you're looking at something like a book value of a stock, you can take the book value of it and compare it to multiplying the float of the stock, which is the total number of shares outstanding times the price. If that number is coming in lower than what the book value represents, then it's a good indicator that there's a buying opportunity, that there's a stock there that is undervalued. Whereas a growth stock is going to be significantly more volatile. It's going to have the potential for higher earnings. But what it really comes down to is value companies are typically more mature. An easy indicator is they're paying a dividend versus a growth company that's probably a newer company and is actively not paying a dividend because whatever cash on hand it has, it's investing back into itself, developing new products, purchasing its way into new markets. But it's a company that itself is still very much in the growth phase.
Yeah, growth stocks really do have this potential to outperform either markets or some kind of a demographic of the market that they're being analyzed against. And a lot of the time, you can find them in the large actually, let me step that back. You can find them typically in that smaller or mid, but even in a large cap sector. So what are they doing? Well, a lot of the times they are, expanding. They're in a massive expansion. And some of those names that we're very familiar with here are going to be like your Netflix or Amazon, NVIDIA, Meta, Microsoft even, and Tesla. So what my dad would have called those is high flyers. Why? Because they're inherent inside of those. There's going to be a lot of volatility around them. One of those measures of book value that we talk about, they're way over their skis. A lot of the time the anticipation is that the market is pricing in that growth that is anticipated. Some of the other names that we want to kind of backstop here in a comparison is in the value sector, you might have the Berkshire Hathaway. Hello, Warren Buffett. That's a great guy if you're wondering who has been a value investor and one of the headliners out there that we've talked a lot about. Other companies in there might be Deere, Procter & Gamble, JP Morgan. Now, I think it's interesting, though, that there's Taiwan Semiconductor in there as well. So it's not all or IBM. It's not all dependent on a part of the market. We used to say technology is growth, and that's all it will ever be, but not anymore. Those companies are large enough and they've been around enough that they're paying, like Dan said, typically dividends in them, that they might be known as a value as well. Again, looking at some of the size of the company, book value, and where it's at presently in comparison to the book value. And a lot of the times there's dividends in there as well.
A lot of people have a problem, differentiating between value and growth, and some things can look a little confusing, right? And I think, one of the probably the simplest perspectives is, as soon as you're stepping into the technology world, usually you're looking at a growth stock. They're not traditionally focused or intentionally focused on paying out a dividend. I think yield, even though a ton of companies who are growth companies do pay some sort of dividend, they're not yield focused. They're not dividend focused. And I think that's one of the big pieces that a lot of people kind of are misled by. Like, for instance, a lot of people, it's like some of the, Microsoft, it's a growth play, but it does pay a dividend. I honestly think of it as like, well, there's a lot of value in Microsoft, but it's a growth play. I think that's one of the big pieces for a lot of people that don't get there. The easy ones, from a value standpoint, we talk about are like the Johnson & Johnsons, the Procter & Gamble's, like those kind of make sense to a lot of people that they're really value kind of companies, right? You're selling really core components in the world around us. But, we don't necessarily get to some of the other areas where, one of the things like Cigna Health or JP Morgan, some of these, financial or healthcare companies, you're not really sure where they play, but they're actually value stocks. And so as you're kind of digging through that, it's really important to know the difference. And I think one of the things that we really try to look for are companies that can kind of bridge the gap between one way or another. Like, I like Microsoft generally. Like, we've traded Microsoft quite a bit. I don't think it's even in our portfolio now. I think we got out of it. But we have traded it successfully, and we watched some of its growth plays really benefit us, as well as when it was down really low and some of the yield kind of became a little more attractive, we played it like a value play, even though it was still a growth stock. So,
yeah, I think it's, the S&P 500 is the the kind of the widest indicator of the market as a whole. And when people talk about the market, that's usually the reference they're making. But it's it's divided into multiple industrial sectors, but it isn't really split up by growth versus value. But if you did break it apart that way, and it's interesting exercise, about 40% of the index is growth oriented, and only about 29% of it value oriented. Where if you look at kind of a smaller index like the Dow, that's going to be much more heavily swung towards the value side.
I mean, and just for our listeners, the S&P 500, it's the 505 largest U.S. companies. I mean, these are not mom and pop companies. These are the big boys. This is everybody that we think you want to work with. From the standpoint of this is the Apples and the JP Morgans and the John Deeres and the NVIDIA. Like, those are all there for you to see. And so a lot of people don't realize that when we talk about the S&P 500. A lot of people talk about diversified portfolio. Well, I'm buying the S&P 500. No, all you're buying is U.S. large companies.
Yeah.
How diversified is that really? And that's a good question when you're investing in your 401k or anywhere else. Do you have a really diversified portfolio if you're just buying, the SPY or IVV, which are the S&P kind of allocations?
But I think these large companies, although they're large, you would think that might eliminate the volatility story, but I think what the last 2 years have told us clearly that's not the case. When you look at some of the kind of leaders in the market this year, I mean, they dragged down the indexes last year to a tune of, depending upon where you were at, 25-30%. But this year, the NASDAQ, particularly these tech companies, have been charging ahead and far outpacing value. So the idea of, where do you want to be, value or growth, it's got a lot to do with your own personal risk tolerance is probably the driver of that decision, quite honestly. But if you look at kind of the overall trend in the market, or not trend, the historical back view, value has outperformed growth when you take a really long view at it, but not in the last 10, 15 years. It's been much more of a growth story.
Well, I think, Seth and I were talking about the other day too, is just the idea that, it's almost like it's the last 10 years that everyone bases this is what the standard is. People don't really look at the historical. And Seth and I were chatting about this when we have all these different meetings that we talk about different investments, and we evaluate, lots of stocks that we never invest in. That's one of the fun things. We argue about them. We spar about them. We really dig into these things. And, one of the things is that, just the current trend or momentum isn't necessarily enough to invest in, because we're looking at historicals that go way past that. We're looking at, opportunities that justify, long-term investing. And I think that's one of the things where, growth has awkwardly, Seth, right? Awkwardly has outperformed value. And that's really not the norm. It's just not. But we've also talked about, and I think for our listeners, like, is that becoming the new norm with the development of tech? Like, we always joke around like, well, is that a tech stock? Because everything is on the cloud and everything is this, and it's all, well, I got to use my computer to use it. Is it a tech stock? Like, so those are one of the awkward things,
Well, I mean, I think if you think of a cell phone or a smartphone, it's gone from, what was high-flying technology, it's totally consumer discretionary, to absolutely core staple, gotta-have-it device.
Right. We joke around like, what, 2 billion people have homes on this planet, but 5 billion have cell phones or something ridiculous thing. I mean, that's crazy. That's absolutely crazy.
You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap. We are talking about growth versus value investing for financial success. Don't go anywhere. Remember to hit the subscribe button as you're listening to the podcast this week, and add a couple to your pocket as you are getting out to the gym, going for a walk, and making it happen.
Are you looking for personalized guidance to kickstart your investing journey? Look no further. Brayshaw Financial Group and our planners are here to help. Our team of experts will provide personalized advice tailored to your financial goals. Visit BrayshawFinancial.com today to schedule your free consultation. Brayshaw Financial, investing made easy.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about value investing and growth investing, a place that we spend a good amount of time. Why is that? We have lots of portfolios that we manage at Brayshaw Financial Group. That's what we do as financial planners, or a part of our business. One of those portfolios that we are active in throughout the week is a large cap, mid cap value portfolio. And what are we doing inside of that portfolio is completely in alignment with the conversation that we're having today. We are looking for good companies that we like, we understand, they have great management, they are positioned in a part of, our economy, or the current legislation passing through, to have some benefits and some tailwinds. All things can be considered inside of what are we looking at inside of these companies. Most of the time, what we're looking for is that, again, that great value, that great company, that great management usually has a dividend. Maybe it's undervalued and it's just not understood right now, or it just hasn't been in favor with a lot of where the money flow has been. Maybe the money flow has been going more into this growth part of our economy. And, part of that makes sense to me. There's a popularity contest a lot of the time happening inside of the market, frankly. And if you take a look in the way that the investment trends have gone, there has been a lot of money going into the venture capitalist kind of an idea. There's just a lot of money out there chasing these growth opportunities. What's the hottest ticket right now? Let's pour our money into that until it's really not something that has really much value, or it's overvalued in terms of the market. And when that happens, what happens? We see a correction. And a lot of the time, people just kind of get exhausted in this storyline of chasing returns and chasing the next hot thing. And they kind of come back into this place of understanding good business making sense over time. And that's kind of where we go in this value story and in our BFG, large cap, mid cap portfolio that I was just mentioning a while. And a lot of the time inside of that, Ben and I and Dan will have these amazing conversations where we just go toe to toe. Our ideas are different. You know, sometimes we're holding on to these no matter what. The discussion in the beginning is we're holding this thing until the cows come home. That's it. And other times we're a little more opportunistic. We're looking for, you know, some fluctuation in the market to grab some gains, and then we're going to take some of those profits and move them into something else that makes more sense. And for us, the makes more sense has to be critical in our thinking. If we don't love it more than the cash we have in the bank right now, or whatever we have in our portfolio at this time, we're going to stay put.
Yeah, I would say, Seth, that's a great point. And I think, you know, one of the things, you know, is we don't, and I love this phrase, we buy businesses, we don't buy stocks. You know, like we're an owner of a company. Would you go and pull money out of the bank and say, I want to partner with you and be part of this business because I believe it's something where we're going to make a lot of money? And I think that's one of the things. Like, not every company and stock do we make money on, but I would say that, you know, like last year we traded Microsoft. I think within an 18-month period, I think we were in and out of Microsoft 3 different times. And it had almost traded flat. And then the market, you know, took off with it and we were out of it, but we still made as much money as where they're at basically now. But we, you know, got rid of a lot of risk at different times when, you know, kind of the risk, you know, pendulum swung the other direction. But you have to really like the business or like the business model. I mean, you know, I don't love every company we own from a standpoint of like, oh, I love what they stand for. I love, you know, all the crazy woke stuff that exists in this world. And I mean, you can find something wrong with almost every company. I think we try to steer as kind of morally neutral or positive as we possibly can in the investments that we work with. We just, you know, we try to stay away from the kind of the crazy stuff. Like, you know, we don't have Target in our portfolio. I mean, they're just, you know, it's just some crazy stuff going on out there. Not worth being in the middle of a political, irrelevant of me not agreeing with everything they stand for. It's not worth being in the middle of that in our portfolio, right? I mean, you just have no idea what the masses can swing something, and it's done quite a number on Target. But really, you gotta like the business, and you gotta like the story, and you gotta believe what they're selling is of value both now and into the future. And it's not a one trick pony. I mean, there's a couple of companies that have done rocket ship well, and then they have to, you know, kind of redesign themselves to continue their value properly. They have to change who they are, and so, you know, like, I think about some of the stocks we're going to chat about here in a minute, and, you know, people, you know, they're always drinking, you know, Pepsi or Coke. You know, I mean, those are kind of some of the things that are out there. So,
yeah, I think, you know, one of the legends of the value world is Warren Buffett, the guy we've talked about on the show a number of times. And he certainly, you know, can do a lot worse than following his mindset over time because it's just been a tremendous success. But one of the things he highlighted as his secret sauce, and he's a big McDonald's guy here, so I think there's a little bit of a play on words there. But, you know, he made reference to this himself, and I think this is a prime example of just wholly successful buy and hold. But 94 and 95, he completed buying into his positions of Coca-Cola and American Express, so 2 name brands everybody would recognize. And at the time, he invested about $1.3 billion in each. And from that point forward, they began producing a dividend at 4.5% was the yield that he bought into. And that was about $116 million in dividends annually at that point in time. Well, those dividends have grown now over $1 billion, $1.06 billion annual, meaning that Berkshire or Buffett is recovering 38% of his original investment in dividends every year. I mean, that is just a fabulous success. If you can think of that, applying the mentality that we've discussed here about buy companies you believe in, buy companies you know, buy into something you can understand, and then be disciplined with it. Hold it because of all those reasons. Don't necessarily react to the trend of the day. And so those are true value companies and a true value success right there.
One of my favorite elements to the value individual companies that we have an opportunity to invest in is the management, and really trying to understand the strengths of those companies, because those managers make all the difference in the world. And what a well-managed company, for one, should have is integrity, intelligence, and energy. And going back to Warren Buffett, I love one of my favorite Warren Buffett stories is the Nebraska Furniture Mart. And Mrs. B is Rose Blumkin, who owned the Nebraska Furniture Mart and started it in 1937. And Warren wound up buying it for $16 million. Tried to buy it years before, like 10 years prior, for like $4 million. And he said, name your price. And she sold it for $16 million. At age 93, I believe, she kind of had a bit of a run-in with her grandchildren, who tried to take over her part of the department store. Which is just furniture, and it was carpeting and flooring was her part. And she left and started another company, kitty corner to this, and Warren went out immediately and bought that from her, because management was just one of those things that you come into every once in a while like this, that you just don't even ask a question. Her integrity was so high, and her ability to go in and understand business and create business was so high, he was not going to even become a competitor to her. And that was one of the things that, taking a look at this whole big picture, competitive advantage is part of what you're looking for as well, in terms of what you're buying into in a company. Like Coca-Cola is a great example. That's a competitive advantage. McDonald's as well.
Yeah. So, I mean, Warren Buffett's done a great job. He's always had that kind of thing of, like never lose money, right? And look to the long term. And he's pretty much lived by those things to his benefit and to his detriment, right? I mean, I think there's some things where, he did end up selling out a lot of the airlines, but then he turned out and lent them a bunch of money at a higher rate, So, I mean, he's not silly, foolish. He's just, he's not ignorant on that stuff, but he is a big proponent of knowing what you invest in. And I would just, I know we're walking into a break here, but I would say that, if you don't really know the company you own, and if you really haven't done the due diligence and you're trading the stocks yourself, like we meet so many people, well, I own this and I own that. Well, why do you own it? Like, we ask that question all the time. Like, why do you have this? Like, what is this? What drove you to pick this investment? And usually it's a friend told me about it, or I heard about this or whatever. And like, they didn't really do the due diligence that's really required, because we do a ton of due diligence, and then all of a sudden, guess what? Some companies still go down, and you still have to really mitigate that, because like you said, I don't remember if it was you or Dan, Seth, but sometimes just the momentum of the market pulls a stock down, but we see strong value in it long term. And I'll continue buying it all the way down because I believe in the company. And we've done that with a few that we've had massive winners with, and that's been exciting.
You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're going to take a quick break. Don't go anywhere. We will be right back with value investing versus growth for financial success.
Hello, everyone. This is Dan Mickelon of Brayshaw Financial Group. Are you looking for professional guidance to kickstart your investing journey? Look no further. Brayshaw Financial Advisors are here to help. Our team of experts will provide you personalized advice tailored to your financial goals. Visit us at BrayshawFinancial.com today and schedule your free consultation. Brayshaw Financial, investing made easy.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And yes, we are talking about value versus growth. Some of these characteristics we've been uncovering here are unpacking here with you. And it's fun for us to kind of get into some of our, I feel like they're heroes, you know, the investors that have come before us and just paved this road and taught us so much, given us so many life lessons. And simultaneous to that, we've had all sorts of scenarios play out in our market where in the moment we might feel like, wow, those rules didn't really work, or you know, they didn't understand, they didn't know what they were talking about. And then we come back into this place that's like, oh, long term, big picture. Wow, these things really did work. And value is one of those areas. And also growth is another one of those areas that have long term had their places. And why do we spend the time working inside of value? Because it does require time to pay attention to what who the company is, or what the company is, who the management is, and why we would want to be investing in this company for a long term. So with that, we've got some interesting little, what do you call them? They're sayings. I know they have a term, but I don't know. I don't remember what the term is. But there's one of them out there, for instance, is, you know, never lose money, right? That's a Buffettism, right? And there's, you know, focus on the long term, which we've been talking about. Know what you're investing in. And then there's other things that we haven't really discovered yet. And we're talking more about that as we go.
Yeah, I think this is a good one from Buffett here, another quote of his. But price is what you pay, value is what you get. And I think that ties back into a little bit of Seth's commentary before about, you know, good management. So he's, you know, Buffett, and he's in a position to not be necessarily overly concerned with stock price, because of the weight of the portfolio he's moving with. But he's looking for companies that provide value. It's companies that have solid fundamentals and they have a competitive advantage and a history of growth, things that he knows are going to play out over time, where the price itself today is temporary and it moves, you know, by the second when the market's open. But the company itself, those fundamental core values that it possesses, are going to be with it for the long haul. And when he likes those things, for him, that's a company to buy. And I think to your point about the furniture store there, you know, he found things in that business that he believed in, and he was willing to pay whatever the price was because he knew it would appreciate.
Even when I'm taking a position in a company or a stock, you know, I'm taking that position, I'm saying to myself, I think this is a good value, you know, and that's, I'm going to pay this price, as you're speaking, Dan, and it may go up or down, but I think I still got a good price for the stock. Right. And anytime you buy a stock, it's always going to go down from that spot. You're never going to make a higher low. A lot of people get really depressed. They buy a stock and then it drops. I mean, it's literally like, hey, I bought this stock and then it went down. It's because, you know, highs and lows are made by, you know, large amounts of trading, and it happens very quickly. You know, that somebody's dumping shares, or they're buying a ton of shares, and the stock just rises because there's more people buying. There's more buying going on than selling at a certain price, so they keep notching up to the next price that someone's willing to sell their stock at. So if, you know, Dan, you're willing to sell your stock at $10, but my sale price is $12, 20% higher than yours, they're going to have to raise their willingness to buy if they want that many shares to my price, because that's what I've stated I'm willing to sell at. And so a lot of people don't really understand the fact that just appreciating a company that, hey, I got a good price on this. It's kind of like when you go to the store and you know, it has a, you know, you're pre-Christmas or whatever, and you're like, hey, it's, you know, it's 10% off right now, and you buy it. And then after Christmas, you're like, oh, it's 40% off. Did you get a good price on it or not? You know, like, and you have to evaluate that and kind of work through that thinking, because it's really important not to get upset when you buy a stock and it goes down, because honestly, you know, you're in it for the long term. If you're really buying into a company and you're partnering with a company, you should be looking at it as a long term. And stop being a trader. Don't think of yourself as a trader. Think of yourself as a business owner, and which businesses do you want to own? Because honestly, if you have to ignore the market, you know, almost the entire time, 99% of the time before, you know, it creates a real issue. We have a couple things that we watch out for. You know, one of the things we watch out for is the 200-day moving average. You know, when the market's moving below its 200-day moving average for a period of time, we actually take action. But other than that, we're pretty much in the market, and we like the companies and we like the stuff we're in, but we don't even sell everything. You know, we make very intentional moves based on certain triggers in the market, the 200-day average being one of many that we look at. And I think we kind of work through those pieces. And I think a lot of people are trying to do this on their own. And for whatever listeners we have here today that are working on this on their own, their 401k, their IRA, their small brokerage account, the CD at the bank, whatever, you're doing this on your own. That is the wrong methodology. And I hate to discourage that because there's a lot of people who, maybe feel like they can't afford a financial planner or not. But we offer some free advice for people, just kind of give them kind of a, quick checkup per se. And I would encourage people to take advantage of that because sometimes when the market's moving, you really need someone to hold your hand and say, this is something I think is passing us by. Don't worry about it. Or, you know what, this is some period of time where you need to take some action and you need to get out of this. And you need somebody who can look at that with an unbiased perspective and really give you some discerning, advice.
Yeah, and I love some of the advice that's being passed on to us there as well, which is be fearful when others are greedy, greedy when others are fearful. And it's that's a really tough one, and that's a very contrarian mindset of the value investor, is really holding on to a position like your cash and looking for the company that makes sense to you. And then the next one here was far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And that is, you ever gosh, I'm trying to think of the person that goes and buys something because it's on sale. It doesn't matter what it is. It's just like, oh, it's a thing. It's on sale, and they can't help themselves, right? Versus shopping the LL Bean, right? It's LL Bean that had like the infinite return policy on your stuff. Am I right?
That's right. Yeah.
Hey, pretty good value on that stuff. Well made. And if you can shop that LL Bean cycle where it's like, okay, maybe I am paying kind of that market price for this LL Bean gear, but doggone it, this is going to work. It's going to last. And that's the mindset that people need to kind of focus themselves in and around when working through the buys and the sells in this area. Overall, let's talk about blending this out a little bit here, because we've talked about growth, we've talked about value. Both have their places. And if you are working through the process of planning, I think it's just important for you to realize that there's an opportunity for you to be invested, and invested well, and invested in great companies for a long term, and take a look at the big part of your picture, which is your income coming down the road, because most of the time we're talking about retirement income, having that piece protected. And then long term, that's that growth. That's also not only the value, but that can also be the growth part of your portfolio as well. And I think that's the diversification that people need to have, or it's a healthy perspective to have around.
And to add,
not necessarily.
Yeah, to add to that, Seth, I mean, it's like you look at the demographics, everything you're saying, just the massive number of people that are getting ready to retire. We got 40 plus million Americans retired. We got 80 million more retiring over the next 20 years. They all want everything you're talking about. They're looking for every ounce of what you're saying. They're like, they want strength in a company, which means they want that security. So that, right. Then they want income. So they want the dividend yields, and they want the ability to know that, hey, listen, this is something everyone needs, right? So they look for those big blue chip kind of value stocks and so forth. But I mean, we chatted about this the other day too. It's, the bond sector is probably for the first time ever in the last 20 years, probably at the best space it's ever been to build, a fixed income portfolio. And you can own some of those great companies that are paying a dividend, a yield, not a dividend, a yield off of the bonds, so that you can have your income too.
Yeah, there's great solutions out there. Actually, while you were talking there, I was just thinking about my kid's been making lemonade. I'm super proud of him. He's out there and he's hustled some serious bucks this summer making some lemonade, and I love seeing him do the activity. I'm glad he's engaged. And also, there's a lot of fruit and juice left over by the time he's squeezing. And what we're talking about here is really wringing out that lemon or that orange and getting everything out of it that you possibly can while you're in this journey. And I don't know if that made sense to you guys or not, but it was just the reality my life and my kids and where we're at. And I just love this part of life, and being here with you guys doing this is awesome. Thank you for the opportunity to be here at Money on Tap with you, to invest with you, to come alongside and really, really put some good work together and get some outcomes for your retirement in place and be successful in your investing, folks. We really have a lot of fun here with you on Money on Tap. Can't wait to talk to you.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.
Well, bye.